All right, so expected return and large language models. This is actually a pretty old paper. So we wrote the first draft of this paper, wrapped up sometime late 21, early 22, and then ChatGPT came out. So we sort of had to rewrite it. We were talking about large language models then. We didn't call them large language models. We called them pre-trained models. We called them foundation models. That used to be the title of this paper, Foundation Models of Language and Expected Returns. But now there's been a proliferation, and that's why we wanted to rewrite the paper. So it's going to attempt to be much more comprehensive. This is not a ChatGPT paper, it's a language model paper. Before we get into the details of what we do, I just want to prime your thinking a little bit, because we're going to come at it from a different perspective from the previous approach. All right, so here's one place to start. This is a real live conversation with ChatGPT. It's not a very deep conversation, right? But it's fun stuff to do. You poke around and you learn the capabilities of the model. So it's a knock-knock joke, right? For those of you that are familiar with it, it's a play on words with the word orange sounding like aren't you, right? So what's unusual about this joke is that it restarts in the middle. So first of all, ChatGPT knows right away as soon as I say knock, knock, how to respond, right? Then I knows how to play the game, orange who, when I ask about orange. And then I restart the joke. And impressively, ChatGPT knows that this is an unusual structure for a knock, knock joke. And so it tries to correct me. And I say, I know what I'm doing, bear with me. And then I got this response. I apologize for the confusion. Orange, you going to continue the joke, right? So it preempted the punchline of my joke, right? And this is kind of what I want to focus on, right? So one thing I want to emphasize is that language models are not magic. They're not intelligence. They're just statistical prediction models. I think it's really important to always remember whenever we're using AI that we are just using statistical prediction models. If we can remember that, we'll be able to make much better decisions about how to interact with it and how to learn from the AI. Right? So GPT is trained to solve this type of problem. It actually looks very similar to the types of problems that we spend so much time forecasting, working on in finance, right? I have a sequence, and then I'm trying to forecast the next item in a sequence. If these were inflation prints, you'd say, all right, I kind of know how to approach that. I'm going to build a statistical prediction model. So all that GPT does is it approaches this problem with a statistical prediction model. All right, so you look at this, and if you're not, my discussant or Alejandro or Winston, you say, wait, how do I do statistics on this? These are words. Well, that's an easy thing to overcome because I can get the computer to read by just carrying around a vocabulary and giving the computer indicator variables, right? A big list of zeros except for a 1 in the position of a particular word that I wanted to think about. Once we do this, we go from textual representations to numerical representations, and now we can do statistics again. So if I wanted to do sequence forecasting like I would to forecast time series of inflation, I can now do it. I have my word vectors. I can use this Bill Murray quote. I can represent the sequence of words with a sequence of these indicator vectors. And just like if I were trying to forecast inflation, I could try and build a model to relate past observations to future observations. And that, in a nutshell, is how language models work. Right? It's not magic. We know how to do this. Why do they work so well? This seems too simple. They work so well for 2 reasons. One is that they've seen absolutely extraordinary amounts of data, right? So GPT, for example, trained on about 500 billion observations. Right? When we train our inflation models, right, we have maybe a couple hundred observations. 500 billion, this is hard for the human mind to comprehend, right? So here's one way that I would think about it. I think if I trained a model on just Wikipedia, I'd be able to build a powerful language model. GPT has seen Wikipedia, but it's less than 1% of all of the data that it's seen. In fact, it's seen all the freely capturable text on the internet. right? That's the bulk of what it's trained on, right? About 400 billion observations. It's seen all of essentially Google Books, right? Every digitized book, right? It's seen a lot of examples of how we talk. It's seen a lot of word sequences and the subsequent words that follow those. I would go so far as to say it's seen essentially everything that we've ever said. Right? That's reason one. Reason two is that the model doesn't look like the simple linear model I had on the previous slide. It doesn't look like our typical inflation forecasting models. Instead of having a few parameters, it has 1 trillion parameters or more. Right? Again, so how do I even think about a model with 1 trillion parameters? If I have 500 billion observations and 1 trillion parameters, I have about 200 parameters to memorize each data point, right? Remember, a data point is a sequence of words followed by a masked word, right? So I can use those 200 parameters to capture the very subtle correlation structures in those word vectors in each example. So I call this a memorization model. That's how ChatGPT works. It's seen everything, and it's flexible enough to memorize what it says, all right? We're just priming, right? We're trying to think about how language models work. All right, so GPT is a word prediction model. All language models are just word prediction models. There's no AI that exists that's anything other than a prediction model of some sort, all right? It happens to be the case that language is kind of interesting because if you memorize language, it makes for a pretty good chatbot. Why is that? It's really just because language is so predictable. The signal to noise ratio in language is so high, it's really easy to guess the next word that somebody's going to say, right? If you memorize past patterns, you start to look like you're a human talking. That's all that's going on in language models. And so what I want to ask is, can this work for investing? And here we can start to have some interesting discussion relating the approach that I want to take to the approach that Alejandro took. Two complementary but quite different approaches. So I'm going to describe Alejandro's approach as prompt-based investigation of language model capabilities, prompt-based signal extraction from text. So how does this work? In a prompt, you feed some text into the language model, right? And then you query it. You ask it specific questions about the nature of that text. All right, so suppose I gave it a news article about Tesla, and then I asked this question, it's going to give me a response. All right. As Alejandro showed, this is a productive way to start to extract information from text that may be useful for investing. All right. Now, prompt-based approaches are interesting. They can be quite powerful, but they also have some limitations. And what are some of the limitations? Well, one is you need a researcher to make the prompts. And just like any model building in economics, your models are only as good as the researcher's design. So if you know the right questions to ask, prompt-based approaches could be optimal. But if you don't know the right questions, well, they could totally miss the mark. That's the main thrust of the point of this paper. Right? So I think about this as very similar to the difference between hypothesis-driven versus data-driven research, right? I think about it as bias variance trade-offs, right? When we build models, when we develop theories, we're writing down biases, right? These are not unbiased models. They are highly biased models, and we think they can work because we think our biases are somehow correct. And if our biases are wrong, we have misspecified models, and the models don't work so well. If you have a biased model that's misspecified, you can do better with non-parametric approaches, which are less biased, more unbiased, right? So if you're really good at asking questions and asking the right questions, prompt-based approaches can work really well. But if you're not too good at it, you might want to find a different approach. And that's going to be the approach that we're going to take. There are going to be some other limitations of prompt-based approaches to querying language models as well. So there might be biases in the training text. So if I ask a specific question, I might mean something, but the way that I use that language might be different than the way the language was used in the text that the model was trained on. So I'll get answers out, but they won't actually correspond to what it is that I was looking for. It's another way that you can have sort of misspecification show up in ways that maybe you didn't even expect. All right. And of course, not every model can be accessed with prompts. Right? There are a lot of language models out there that are really powerful language models, but that really don't have the kind of prompt capabilities that you saw in the prior paper. All right. So now I want to go back to thinking about GPT. I'm going to go one layer deeper to think about the structure of GPT. All right. So I'm going to stick with this Caddyshack example, and I want to ask, what is it that those trillion parameters in GPT actually do? Well, what they do is kind of intuitive. What the model has essentially learned, right, is that if I take in words and I'm trying to forecast subsequent words, I don't really want to stay in the space of words when I build my model forecast. Instead, what I want to do is I want to take those words and compress them down to their meaning. And we think about that meaning as living in a lower dimensional space. Sort of analogous to principal components, right? We have some data on words. These vocabularies are huge, so we pull out principal components of the words data. Right? Think about that as a compression of words into meaning. So maybe Cinderella is not that useful for me to think of as Cinderella per se, but to think of it as living somewhere on a human spectrum, on a gender spectrum, on a literature versus reality spectrum, and so forth. That's the way these models actually like to make future word forecasts. So they start with the decompressed inputs, and then they compress the language down to some numerical representation. The model doesn't name these dimensions. It just has a numerical representation that tries to faithfully summarize in some numerical form what the content of that text actually means. And what the model has learned is that the best way to forecast, compress to the meaning representation, and then try and forecast the meaning of the next word. Don't forecast the next word itself. Only after you've forecasted in the meaning space, then does it make sense to decompress and pick out a particular word. When you pick out that particular word, that's what gets shown in the response to your prompt. All right, so I want to look at this structure and say, well, where can I sort of sidestep some of the biases of prompt-based approaches? If I'm working with a prompt-based approach, I'm sitting here trying to ask questions that spit something out here that's useful to me. But internal to the model, I have a bunch of information at my disposal. Even if I don't ask a question, the model is always going to take the text that I prompted it with before I ask a question, right? Let's say the raw news article, and it's going to start to produce meaning representations of that news article, numerical representations. So I'm not going to ask questions about those numerical representations. I'm not going to ask, is it good news, bad news, positive sentiment, negative sentiment? I'm just going to go into the model and pull out the numerical representation. And then I'm going to sort of reroute that numerical representation into the types of models that we build all the time. Statistical return prediction models. I don't need a prompt to do this. All I need to do is have the capability to go internal to the model, capture this numerical representation of the text that I fed it, pull it out, and plug it into a different machine. That's the approach that we're going to take here. All right, now I think it's useful to contrast these two approaches a little bit more. So start with some raw text. If I ask a question of that text, right, I'm sort of bypassing all of the details of what's happening inside the machine. So instead, what I'm going to do is try and capture a faithful numerical representation of the text without asking for anything in particular. The prompt approach does something different. It asks for specific things. Both of these can be useful. They're quite different, right? So searching for specific content versus capturing general content. That's one way to think about it. Fishing with a rod versus fishing with a net is another way to think about it. Or again, this always comes back in statistics to a bias-variance trade-off. This is a biased approach. And if you can engineer the right prompts, you can nail the answer without getting distracted by all of the other content that you've captured. But if you don't know what it is that drives future returns, or you don't fully know what it is that drives future returns, and I'm willing to admit that I don't fully know what drives future returns, then I want to have an open-minded net. And I want to ask my prediction model for returns to say, where in this numerical representation is there useful stuff for predicting returns? So that's going to be the formulation that we take here. All right. Now, in terms of the empirical approach, from here on out, it's just detail. The data we're looking at is about 25 years of news text for single name companies. We're working with the Thomson Reuters Refinitiv data here. I'm sure a number of people in the audience are familiar with it. It's a big, dense data set. It has all kinds of news in it. A lot of it includes things like, it's typical newswire data, has some things like press releases and so forth. We have a lot of data. This is an advantage. We have a lot of data in any country, but one of the cool things that we're going to be able to look at is we have a lot of data across countries here. We have foreign language news. And from the perspective of most large language models, it doesn't really matter what language we're looking at. And that's pretty cool and can be quite powerful. All right. Now, we've talked about ChatGPT quite a lot today. I'm going to go on a limb and say ChatGPT is nothing special. There are a lot of language models out there. There's an entire universe of language models that exists, right? They come in lots of different varieties. They're produced by lots of different researchers. They all have sort of the same structure to them, which is what I laid out before. They take in some text. They run those texts through a prediction structure. That prediction structure is usually pretty complicated. Many layers of sophisticated neural networks. And somewhere before it produces its word forecast, it has an internal numerical representation of the information that it thinks is useful for predicting future words. So for each of these models, this is what we're going to do. We're going to go into the model and pull out what we call the embedding layer. All right. Now, there are lots of potential embedding layers inside a language model. What we're going to typically do is take the last numerical representation at the end of the neural network. All right. There are different ways that you could do this. This paper is not really about those details. The point is, once I feed a news article into a language model, I get a vector of predictive signals out. It's typically a pretty high dimensional vector. Have in your mind a vector that's about 1,000 dimensional, right? It varies across different models. That's what I'm going to capture. That is going to be my net that's trying to summarize the information content of a news article. All right. Once I have that X, that vector representation, that numerical representation of the article content, it's kind of easy from there. We're just going to build return prediction models like I had any other numerical data. For every article's about a stock, I have a future return I can attach to it. So I'm going to build prediction models. In this paper, we look at two ways of building prediction models. One is to literally build a prediction model, forecast one period ahead returns using the embedding that I see today. The other way is to think about it sort of more like a news momentum type of thing, which might be something that Sophia will talk about. She's worked on this topic in the past, the idea of news momentum, which is to say, what is the contemporaneous association between text and returns? And if I can see the text today, it's sort of giving me a signal of what I think is that price impulse that might eventually translate into a momentum effect. So we'll also look at models that look at contemporaneous returns. This is all, of course, we do that estimation in sample, but then when we bring it out of sample, right, there's no mechanical fit of what I see in a news article today and what I think will happen subsequently. So those are going to be the approaches that we're going to look at. I'm just going to show you a couple of results, and then we're going to be done. All right. I have a couple of benchmarks, called them pre-LLM benchmarks, that I want you to think about, because we were using text before ChatGPT. We were using text before BERT. How did we do it? Well, if you go far enough back in finance, we started using things like psychological dictionary scoring schemes. So there were some researchers that collected a set of words that had different psychological, emotional charges to them. Right? This is something called the Harvard 4 dictionary. And so if you were a researcher and you wanted to look at a news article and ask what was the sentiment of that article, you'd say, all right, how many words in this article show up in this psychology dictionary? And what is the sentiment score of each of those words? And I just added up. It would give me an overall document sentiment score. Right? The problem with that is that what goes on in finance is kind of different than what goes on in psychology when we think about sentiment sometimes. And so some researchers at Notre Dame said, let's build our own dictionary that's more relevant for finance. Okay? So you can think about this as a fairly powerful dictionary-based method for sentiment scoring. Sentiment always needs to be in quotes when we do textual analysis for finance. We say sentiment all the time. Much of the time, this has nothing to do with sentiment. This is just about information, right? But it's a sentiment scoring method that's a dictionary-based method. The great advantage of this approach is that you don't have to do any estimation. The coefficients are essentially the sentiment weights in the dictionary, right? You get those handed to you by the researchers, and all you have to do is score your articles without any training of your own. What Da Cheng and I did with another statistician, Tracy Ke, in an earlier paper was say, how do you generalize dictionary methods? I think that it can be misguided to apply the same dictionary to many different types of problems. I would like to be able to build a dictionary problem by problem. Well, in order to do that, I need to decide on what goes in the dictionary, what are the weights that are assigned to each of those terms. And so we built this statistical model called SESTM. Think of it as an early stage machine learning model for financial textual analysis. All right. And then there are some other non-large language models that also give vector representations of words from prior literature. In any case, these are going to be benchmarks because these are word methods. They're not entire document embeddings. So they don't really know anything about the context in which a word is used. Right? What's really useful about large language models and the ability to embed an entire document is that it takes into account things like negation, subtlety, and so forth. All right. So I guess I should say one other thing before I show you this picture. What I'm going to do is, in a rolling training window, estimate a model like this. For every stock, in my rolling training window, I'll get an estimate of these parameters. All right. Now, I'll take these parameter estimates and bring them one period out of sample. Now, new articles arrive. I will apply these coefficients to the embeddings of new articles. Those embeddings, combined with my previously trained coefficient estimates, will give me an expected return for every stock on which I get a news article. Based on that, I can start to sort stocks into portfolios. This is just a signal like any other signal that we use in asset pricing. So I'm going to build decile, long, short portfolios. I'm just going to look at the performance of these portfolios when we go out of sample. So this is what I'm going to show you here. All right, here we go. So we have a number of different models that we look at here. So we have a number of results to focus on here. So these are annualized Sharpe ratios that I've highlighted for equal weighted strategies. Looking at ChatGPT, a couple of variety of Llama models, couple of variety of BERT models, and then some of the simpler benchmark models, word-based methods down at the bottom here. So the first takeaway is that this is a powerful way to extract information from text. As Alejandro sort of emphasized, when you do daily strategies, we're not trying to interpret how much money you can make, right? We're trying to interpret the extent of predictability in this data set, right? So based on this, the extent of predictability is high, right? If you remember the daily Sharpe ratios that you saw earlier, they were probably in the 3 range. With just a simple linear model based on embeddings and some of the larger language models, you can go north of 4. There's a lot of predictive content in these news articles. I said that this is an approach that can be used in any language, right? I can embed a news article in Chinese, I can embed a news article in French, and I can embed a news article in English. So what we did here was we basically built these same strategies in different countries, right? Now, in different countries, one of the things I have to deal with is that I have very different numbers of assets to trade. And so one thing that we found here is that if I plot on one axis the number of stocks that I have, and on the other axis, the performance of a trading strategy that uses embeddings-based language model representations to build these strategies, well, The more stocks I have, the better I can train a model to learn from the embeddings how to trade those stocks, right? So the models are polyglot. The more data you have, the better for training the return prediction aspect of those models. And that's true for most of the models that you would look at. You notice that when you get down here to the more traditional word-based methods, that relationship gets weaker, right? Another thing that we wanted to think about was, well, if I have these embeddings, should I be using them in a linear model? Is there a more effective way to take advantage of the information that's represented in those word vectors? So rather than using, a simple linear function of the embedding vector to predict future returns, why don't I start to consider some nonlinear functions? Maybe tree-based methods, maybe some neural networks. It turns out that there's a lot of richness in these vectors. Using them in a linear way understates the amount of information that you have access to for return predictability. So if you recall in the previous slide, that predictive metric I was looking at, the Sharpe ratio, it's on the order of about 4.7 or so. Now we're looking at 5.8 with a neural network-based method. So naturally you want to start to think, why is it that these LLMs are doing so much better than the word-based methods that we were seeing a moment ago? So, right, if I go back to one of my old favorites, I capture a fairly high degree of predictability from this system-based approach, right? This word-based approach, this generalized dictionary approach. And I can improve on that pretty dramatically if I go to, say, a Llama model or a ChatGPT model. Why is that happening? Right? Remember, the key difference here is the lack of context in word methods. How can I show that? How can I actually investigate that hypothesis, that it's the lack of context in word methods that's hurting me? So here's how we did this. We have a couple of analyses like this in the paper. But what we did was we said, let's just use articles that have prevalent negation terms showing up, not this, didn't that, and so forth, right? And let's build strategies that use articles without negation terms and articles with negation terms. And right away, what you can see is that for the more sophisticated models, which are shown in red here, if I look at strategies that do and do not use negation word articles, the performance doesn't differ very much. Negation doesn't give the more sophisticated context-based methods a hard time. There's quite a big degradation when I go to negation articles if I use word-based methods. So I have an example on the previous slide. I'm running a little bit short on time. The point is, if I see a word like raise shows up here, raise in any dictionary-based approach is a typical signal for a strong future return, right? But this is talking about raising issues that have to do with the ability of British Airways to operate in the EU after Brexit, right? So it's a misattribution. It says this is a very positive article on net, but once we pay more attention to the negative terms that show up, it mutes that signal. This is why the context-based methods do better. All right. I walked in towards the end of Alejandro's talk and Winston's discussion. I heard there were a lot of questions about implementability here. All right. I'm not going to spend a lot of time addressing implementability here, but one thing that shows up that I think is interesting, I kind of couched it in a different way. Less about implementability, but more about the frequency of signal in text. So what my results have shown and what Alejandro's results show is that there's a very high frequency signal in text, right? Text today is very predictive of the return that's going to realize tomorrow. Many questions in the audience about then the implementability of that, because we know it's hard to trade daily. That's fine. But it turns out that if you start looking at longer horizons, right, the signal goes away, but then it comes back. So here's how I want to think about horizon. I'm always going to forecast 1 month ahead, but I'm going to aggregate articles at the firm level going back different amounts of time. If I go back 1 day, that's like using the approach that I use in my 1-day setting, there's no profitability to trade on the news-based signal over the next month. It all decays very quickly. But as I start to average over longer and longer time periods, which are shown in the different components of the tables here, all of a sudden, the performance of the monthly trading strategy starts to improve. That's telling you something really interesting. There are two prominent frequencies in text data. One signal that moves around really quickly, and one signal that moves around much more slowly. Something like business cycle frequencies, right? And that's something you can capture and trade on out of samples. All right, the last thing that I want to touch on is to try and do something with the fact that we're not just looking at ChatGPT here. There's a great advantage of not having a single language model out there. Different language models are built by different teams. They do different things. They have different assumptions underlying them. And they produce different trading strategies. So what I'm showing you here is a correlation matrix and the returns in each of those long-short trading strategies. So for example, the ChatGPT and the Llama strategy, they're about 60% correlated. Even if I use two different versions of Llama, I get strategies that are about 80% correlated. These are not the same strategies. And then when I start to compare to, things like some of the traditional bag of words approaches, you get much different correlations going on here. One thing that I'd emphasize about these bag of words approaches, especially the SESTA model, is that this model is trained in a different way. It's not pre-trained. It's actually been trained with my data, and it's not been trained to predict words. It's been trained to predict returns. So these models don't displace word-based methods. And word-based methods, as you saw from the Sharpe ratios, sure as hell don't displace the LLMs. In fact, they all give you different perspectives into what the language in an article has to tell you. This, by the way, is a reflection of issues associated with statistical complexity that I talked about last time that I was at this conference. So I said, if you have very highly complex models, you can measure signal better, but you have to deal with the issue that you have finite data. And in finance, we have finite data. These models are not trained for the data that we care about, returns, right? They're trained to predict words. By the time we translate them into return predictions, we can learn different things from these different models. They're going to teach us different things because we don't have enough data to learn the signal and the text perfectly from any one of them. What is the upshot? Well, when you see a bunch of trading strategies with high Sharpe ratios and partial correlations like this, what should you do? Put them together, right? And when you put them together, you can say, all right, my best individual model was producing a pretty attractive Sharpe ratio. There's a lot of predictability there, but I can do even better, all right? So this is a simple equal weighted ensemble. A more sophisticated ensemble would do even better than this. All right, so I'm a little bit over time. Main punchline is that embeddings from LLMs are an effective way to extract numerical representations of all of the meaning that's in the text, not specific meaning, but all of the meaning, right? And I like the embedding because you can think about it as an open-minded funnel for capturing lots of different potential predictors for returns, right? I don't have to know what the nature of the text-based predictors are to begin with. I can start to learn them from the data if I capture them broadly, and that's what embeddings do for me. So I contrasted this with some of the potential limitations. There are also benefits of human-based prompts, and very likely a combination of these will be optimal. Why? Because this is a setting with finite data. Bayesian approaches that combine prior and data models tend to dominate out of sample, right? So we saw strong statistical success. Larger models on average tend to perform better. It's a polyglot method. There are some interesting multiple frequency behaviors in the data. And we have a lot of models to choose from. There's no need to focus on one of these. They're all going to kind of pick out different aspects of information, correlated, but different aspects of the information in text. So thank you.
Thanks, Bryan. Next, Sophia Lee will present the discussion.
Thanks a lot for having me discuss this wonderful paper, Expected Returns and Large Language Models. It's my second time to the conference. Last time was 2 years ago, discussing a momentum reversal paper. It feels great to come back to catch up with old friends and make new ones. All right. So right now in business fields, there are two hot topics. One is AI, the other is ESG. Okay, so when we talk about AI application in finance, we have to mention Bryan's seminal work, Empirical Asset Pricing via Machine Learning. So this paper is only a few years old, but has gathered more than 2,000 citations, and the numbers of citations growing on a daily basis. Okay, so this paper has inspired a large body of follow-up work, including my very own work. Okay, for instance, my work, automated volatility forecasting, applied machine learning to predict the realized volatility for SP 100 and SP 500 stocks. And my other work, forecasting and managing correlation risks, applies machine learning to predict the realized correlation among SP 500 firms. We show that when we combine big data with machine learning, we're able to not only predict those risk matters better statistically, but we can also generate significant economic gains. All right, so what this paper does is to apply state-of-the-art large language models to news for predicting returns. Okay? The scope of the paper is very broad. It considers 16 global equity markets and news articles in 13 different languages. Okay? So Bryan has delivered a very powerful, clear, and also entertaining talk, like he always does. In fact, in my opinion, if Bryan has a talk show, he's gonna be more popular than Jim Cramer. Okay, let me just recap what the paper does. So the paper first considers state-of-the-art large language models, including ChatGPT, LLama, LLama 2, Robot A, and BERT. Okay. It also considers like a simpler word-based models such as Word2Vec, SAST, and LMMD. So the word-based models, they ignore the context, but it's like those matters easy to construct. It also considered machine learning models such as Ridge, Lasso, Random Forest, and neural networks. Okay, so the paper focuses on two analyses. The first one is sentiment analysis. Okay. So they use textual features from news articles to predict the binary outcome. The outcome is 1 if the return is positive, and it is 0 otherwise. Then they compare model performance on sentiment prediction accuracy and return predict power using news sentiment. The second analysis is on return prediction. Okay, so they estimate the Ridge model using 1 day ahead return as a dependent variable and the textual features from a model as inputs. Okay. Then they use the predicted returns instead of sentiments as sorting variables. So now, what are the main findings? Okay. So the main findings are that returns respond slowly to news due to various reasons. It could be investor inattention, the complexity of news, market efficiency, etc. Okay, and large language models, they outperform traditional word-based models in both sentiment analysis and return prediction. Okay, so overall, this is extremely comprehensive paper, like big data, 500 billion news, tons of analysis. And in fact, it's fair to say that the authors have put the efforts for writing 3 papers into 1 paper. Like, I remember I presented my correlation prediction paper at the Q conference in the spring. And one practitioner criticized my paper for being too long. And they just mentioned Bryan's paper. I think if I recall it clearly, your replication crisis paper has an appendix of 50 pages, and the virtual complexity paper has an appendix of 70 pages. So this paper, I mean, the font size is small, so the length is not long, but there are tons of materials in the paper. Like, I think somebody else might split it into 3. So 1 paper comparing large language models with word-based models, 1 paper comparing large language models with machine learning model, and the 3rd paper would be international evidence. But this is Bryan fixed effect. You put everything into 1 paper, very comprehensive, looking for the high impact. Okay, so this paper is also very highly educational. Okay. So it includes excellent details on models and implementation, and I highly recommend it to everyone. Okay. So that said, I expect a similar high impact to that of Gu, Kelly, and Xu in the years to come. Okay. So my role here is to offer some comments. Okay, so my first comment is on the sentiment score. Okay. So the primary aim of sentiment analysis is to delineate relationship between specific text-based features XIT and the binary sentiment label YIT on training articles. So here, sigma is a logistic link function. Okay. So to achieve this, we require a sentiment label for each article in the training sample. Okay. So what authors do is to create the sentiment labels based on the 3-day returns surrounding the news article. Okay. So in my opinion, the 3-day return as a label, the window might be too long. So here is why. The 3-day return might not be sharp enough due to confounding news or even non-news market moving events. Okay. So my recommendation is to use high frequency and instantaneous market reaction to news, such as 15-minute return. This could be more meaningful. Again, I'm a big advocate for high frequency data. Most of my papers use high frequency data for return prediction, risk management forecasting. Okay. So this is figure 4 from the paper. Okay. So it plots the cumulative return of the 1-day ahead portfolio performance based on L-Llama 2. So the top line, the black line here shows the cumulative return of the equal weighted long short portfolio, whereas the black dotted line here, it shows the value weighted long short portfolio performance. As you can see, there's a big difference, right? Big difference. So the significantly lower long short portfolio return for large firms is likely due to more confounding news and a faster price reaction of large firms. So my first recommendation to Bryan and the co-authors is to use intraday high-frequency return as labels when training sentiment score. And my second recommendation is to compare with manual labeling by expert readers. Of course, you have so much news, it's difficult to hire expert readers, to do the label. But at the very least, you can compare with existing sentiment scores, such as Bloomberg News Sentiment. So their sentiment score is fine-tuned using data sets that include expert-labeled sentiments. You may also use the Refinitiv, formerly the Thomson Reuters News Analytics. Their models are trained using a combination of machine learning and expert-labeled data. Further, you can use stock twists. The platform aggregates user-generated content and assigns sentiment scores based on positive and negative mentions of stocks. And finally, Raman-Pak. I believe you have another paper that conducted some analysis using Raman-Pak sentiment. You can include that in the paper. My second comment, like Bryan mentioned, is to benchmark to the news momentum strategy of my paper, Pervasive Underreaction, Evidence from High-Frequency Data. So in that paper, we combined high-frequency news with high-frequency market data. We didn't use any text analysis, large language model, not at all. So this is what we do. On each day, we divide the close-to-close return into 26 overnight and 15-minute returns per day. Then we denote the return in interval J on day T as RTJ. So J is from 1 to 26. Okay. Now we combine intraday firm-level news and the return data to create news-driven returns. Okay. So the news return on day T in interval J is equal to the raw return if there is a news story in interval J and it's zero otherwise. Okay. Now construct daily close-to-close news return as signals. Okay. So the daily news return is aggregated from all the high-frequency returns within the same day. Okay. Lastly, we use the 1-day news return signal to predict the 5-day ahead return. Okay, so this is the performance of the original data between year 2000 and 2012. As you can see, the news momentum strategy continues to rise over the entire sample without major drawdown. On the other hand, the traditional momentum has a crash around 2009. Very poor performance. So during the revision stage, the referee asked for the auto-sample evidence. So we tested the performance during the period from 2013 to 2019. And you can see news momentum works great. So over the entire sample between 2000 and 2019, with a $1 price filter, the equal weighted annual return is 34%. The value weighted annual returns 25%. So it survives transaction costs. In fact, a leading hedge fund still actively trades on it. So yesterday I was talking with Bruce and Ken about my other paper. So they were interested in my other paper. But if you want to try, you probably want to implement this strategy because it is still working today. And this strategy is very easy to implement and very effective. So it can serve as a good benchmark while evaluating large language models. So my third comment is about whether the predictability is front-loaded. So this is a strategy. This is a timeline of the strategy in this paper. So the authors use news between 9 a.m. on day t-1 to 9 a.m. on day t to predict 9 a.m. to 9 a.m. return on day t+1. So assuming a daily TC of 10 basis points for large stocks and 20 basis points for small stocks, the net or after TC net new Sharpe ratio is around 1.5. But what if the predictability is front-loaded? That is, it may be concentrated at the beginning of the holding period, such as 1 minute after 9 a.m., where immediate trading is difficult. So the predictability of large and liquid stocks might be more front-loaded. So it might be worth conducting a more granular analysis at the intraday level. So my last comment is about the news category and the news clustering. You may want to examine news separately across various categories. The predictability is likely stronger based on fundamental news. And you may also want to explore clustering effects. For example, you may want to test whether holding period return based on previous day's news signal is driven by the momentum of news. That is, good news is followed by good news, and vice versa. So to conclude, this paper is extremely comprehensive and highly educational. I expect it to have high impact in the years to come. Overall, it's very well written and very enjoyable to read. I highly recommend it to everyone. So in my own opinion, it requires some further analysis, such as comparisons to alternative sentiment scores, benchmarking to the news momentum strategy, exploring possible front-loaded return predictability, and examining news categories and news clustering. Thank you so much for your attention. I look forward to reading future version.
So on the ensemble approach you're talking about at the end, you were combining models. I wonder, is it also possible to take the embedding layers from multiple models at once and put them into the return prediction?
Yeah, that's interesting. Yeah, we just did the simple average of the forecast. So you can build new comprehensive models that take multiple of them.
Yeah. And simple question, where do I get these embedded? I mean, can I just ask ChatGPT, give me your final layer on this text?
Yeah. So you're not going to, you don't want to do it via the chat interface, right? But any of your Wharton PhD students will do it for you.
My question is about the sentiment analysis versus the return prediction, right? So you have two approaches for Sharpe ratios. When you use the Llama model, you find that when you go from sentiment to return predictions, your Sharpe ratio takes a huge spike up. So it goes from 4 to 5. But I've noticed that when you use ChatGPT, there's actually a degradation in Sharpe ratio. Why is that?
Yeah, I don't know. It's a good question. So maybe just a comment on return prediction versus sentiment.
Yeah.
This is another dimension in which we could ensemble. Right? They do different things. One is looking for contemporaneous correlations between news and returns, and then essentially folding that into a news momentum type of idea. Right? I see the news today. Typically, it associates with a big return today. and I know that there's typically underreaction in markets. So when I see a news impulse out of sample, I can't trade on it contemporaneously, of course, but I think because I found a news impulse that tends to correlate with contemporaneous returns, it's also going to have some predictability subsequently, right? Whereas the return prediction method goes directly to that predictive association.
Right.
They do different things. And when you have limited data, different formulations for statistical models are going to learn different things, correlated to different things. Key aspect of this idea underlying the benefits of using big, complex models. We have limited data. Data has a lot to tell us. It just doesn't get to tell us very often, right? So we want to have comprehensive ways of thinking about it. So that's why we consider two different approaches here. Very difficult to understand what are the differences in the things that are being picked up. It's one of the common critiques or questions that you get around anything that's machine learning or AI oriented. What's the interpretation?
Yeah, no, I just thought it was interesting that ChatGPT would not do the same job that Llama would do, right? You'd expect it to improve. Second question is about the Sharpe ratios, right? You point out 4.5, but I think in your paper you also talk about transaction costs. And I've seen a grid with different gammas, and your Sharpe ratio degrades from 4.5 to 1.5. I think Sophia mentioned something about the open-to-open trading. Now, as a practitioner, I can tell you that open-to-open doesn't really work, right? Because the liquidity on the opening imbalance is pretty low, and the stocks can move a lot. Have you tried something like a VWAP or a close-to-close? And if you have, would the Sharpe ratio go down further from 1.5 to maybe sub 1? Because my null hypothesis is that it would. Do you have any research you've done on that?
Yeah, so, I mean, as a practitioner, I can also tell you that it's very hard to trade any size at this frequency, right? So the question...
Intraday. You can trade intraday VWAP.
I'm talking, yeah, I understand. But I'm talking about trading at any size, right? A meaningful size. You can trade this stuff, right? And maybe the hedge fund that Sophia talks to is trading relatively small AUM. It's hard to trade any meaningful AUM at this type of frequency. So these daily results, I really want to emphasize that they're meant to be interpreted as predictive associations. What is the news content? And how quickly does that news get impounded in future prices? That's what those daily Sharpe ratios are meant to tell us. I really want to stay away from interpreting these things as tradable in any real sense. We have a trading cost analysis in the paper because referees make it. What I think is more interesting is think about lower frequency trading strategies. Okay? And so we do have some analysis around that as well. It's not in the draft here, but it was in the slides. That's more interesting.
Hey, Bryan, related to the lower frequency trading strategies and maybe similar problem as the one that I gave earlier this morning, have you done a comparison against the more traditional factors? And like as Sophia pointed out, there's definitely a small cap component, but
Yeah,
are there like other things, especially like, again, wearing your practitioner hat in the context of what you guys are doing with factors you've been trading on from a very long-term perspective?
You can control for all the usual suspects. It eats into it a little bit, but we know the limitations of those types of controls typically. But in the standard type of spanning analysis that you would do, you see that much of this is out there. Not 100% of it, but the bulk of it.
My understanding is like using embedding to train your own return predictability model, and then you base on this signal, you construct long-short portfolio. But I'm thinking, even for the low frequency, why can't you just using this embedding is really cool to train this trading strategy directly, and taking into account this kind of trading costs.
Do you have a different strategy for each embedding dimension?
Yes.
Element of the embedding vector?
Yes. So you can.
There's sort of an isomorphism between what we do and that. If we work in linear models and we have a particular objective function, right?
Yeah.
So I talk about that in some of my other papers. So once you're in linear world, right, the distinction between building a stock forecasting model with signals versus building a factor model, right, using those signals as managing characteristics for the factors, it's sort of a one-to-one match.
But once you go to nonlinears, especially
once you go to nonlinear, it'll be different,
trading this
right?
kind of
And
heavily
then
trading.
To make that isomorphism hold in the nonlinear setting, as you will know as well as anybody, now I need an infinite number of factors, right? Which is why large factor models get to be really powerful.
Yeah, on the topic of signal frequency, you say you know, instead of like looking back a month, you look back more, right? Are you using the like expanding window or more like a rolling window?
Yeah, so these are sort of looking back, calculating rolling averages
Okay.
of embeddings of news stock by stock.
Is there like sort of like optimum, like the size of the window?
In the table I showed, it sort of peaks around 2 years,
2 years, okay.
which is why I kind of made that statement about business cycle frequencies.
Oh, okay, makes sense.
Thanks. All right, thank you very much.
Thanks very much, Bryan.